In this presentation, we're going to add draws using our bank feeds. Let's get into it with Intuit's QuickBooks Online. Now we're going to go back down and we're going to be opening up our reports. So let's open up the reports. Let's just open up the balance sheet this time. The balance sheet is all we need, I think, at this point. So we'll open up the balance sheet. We're going to be changing the dates up top, those dates from January. Let's break it out to the end of the year because that's just easier to type, 12/31/20. And then I'm going to say run that report. Then we'll duplicate that report, right-clicking on the tab up top and duplicating it. Then we're going to go back to the tab to the left, and we're going to go down to the banking, and we'll close the hamburger up top. We don't need that hamburger bugging us. And there we have it. So we're getting down there on our transactions. We're looking at the draws now. So the draws are going to be the items that are going to show, when we see that on the bank feeds, it might be called draws, it might be called withdraws, or something like that, but it's not going to give us a lot of information because it's just cash that came out of the checking account. So we can imagine an ATM withdrawal or something like that. How are we going to enter that into the system? We talked about that in month one, where we said we ask the owner. Let's imagine we're the bookkeeper. We ask the owner. We're going to have to ask and say, hey, money just came out of the account. I don't know where to put it. I'm hoping that I can just put it to withdraws account. But if it's for some type of expense, you're going to have to tell me where to categorize it. Last time they said it was some type of expense. We had to categorize it. We put it into miscellaneous expense. This time they're going to tell us what we hope to have to be the case. And this is how you should set things up if at all possible. Anytime you take money out of the checking account, you just take cash out of the checking account, it should only be for personal use, right? If you're drawing money out of the checking account and it's just a draw, then that only happens if it's for personal use. If there's any business use where you're actually spending money for business purposes, then it shouldn't be in the format of a draw because you really want to track those items. You want an audit trail, right? I want an audit trail. I want it to be shown on the credit card. I want it to be shown on the bank statement so if I'm audited on those types of legitimate expenses, they are there and tracked. If I have just a cash drawn out, then it's harder for the bookkeeper to do. It's harder to keep track of the books, and I have less evidence in case of an audit or something like that. I'm going to have to go to basically receipts or something to kind of support the cash transactions. So what you would like to do is say, hey, any kind of legitimate business expense I'm making with a credit card or a check or a bank transfer, or something that I can clearly trace out and we'll have an audit trail. Anytime I pull cash out of the account, if I'm just pulling money out or transferring money out or something like that, that's because I'm taking it out of the business and putting it into my personal account as the owner, if I'm talking in the owner's shoes right now, so that I can use it for my personal purposes or invest it on a personal side of thing. That's how you kind of want the system to go in place. So if I see money just coming out, then what am I going to do on a bookkeeping side? If I go to the balance sheet, obviously, and I hold down control, scroll up a bit to that 125. Obviously, the checking account's going down. The other side, we're going to put into draws down here or some type of equity account. That means it's not going to affect the income statement, right? If I put it on the income statement, we're going to record some kind of expense typically, which would increase the expense, lower net income, which wouldn't be correct if it was taken out for personal purposes. So what we want to do is put it into the equity section here, and that's going to be the main thing we need to do. And QuickBooks gives us this account called Owner's Pay and Personal Expense. So that's where we're going to put it. And so if I'll go back to, and just remember, if there's any other expenses that happen that are going to be like Disneyland or something that's clearly personal that you see on the business side of things, it's not the end of the world because it just means they didn't take the money out and then spend it. When you recognize those things, it's going to muddy up the books, but you can still simply find those items, that expense that went to Disneyland, check that went there or whatever, and simply record it not to an expense, but rather to the equity section, kind of like a draw. So the money came out, you'd record the other side to the equity section, similar to a draw here. So remember in that case as well. So if I go back to the first tab and we're going to say, all right, so it's going to be a draw. This time we could put a vendor, could be the owner's name. I'm going to leave it blank here because that's one area where it's not really a vendor or customer and it may not be necessary. I'm going to then look for the equity accounts. So we're looking for equity. I'm looking on this side for the equity type of accounts. There they are, and we want the owner's pay and personal expense. That's the one. That's the one we want. I'm going to select that. We're going to say add, and then let's go back over to the old balance sheet. I'm going to go back up to cash. It's not refreshed yet, but when I click on cash, it'll refresh like as we go in there. And then I'm going to go back down and see what we have. This one was the $100. Let's look for it by amount. And there it is. It took a little while for it to refresh, but there's the $100 coming out of cash. The other side is going to be going to the owner's pay and personal expense, which is an equity type of account, which means it's going to be on the balance sheet as opposed to the P&L or profit and loss or income statement. All same name or same report. And then I'm going to go back down to the equity section in the balance sheet. And we're looking down here in the owner's pay and personal expenses. Note that other people might just put it into capital or retained earnings if you see other types of bookkeeping systems and whatnot. Or they might break it out, and this account might be called draws or withdraws or this owner's pay and personal expenses. So I think QuickBooks is trying to get really specific about the things that could go in there. So this is probably not the name that you would typically see in other types of reporting, probably draws or withdraws, but QuickBooks is trying to tell you exactly what's going on here. So then we have the same kind of thing happen in February because we're mirroring what happened in February. Here we have it in April, and there's going to be the 100. Bottom line, or the thing to keep in mind, is that this is not affecting the P&L. It's not affecting the profit and loss. It's not decreasing the net income. And therefore, it's going where it should go. If you put it on the income statement, it would decrease the net income. And again, that kind of gets you, that's where people get in problems with taxes when they write off personal expenses, in essence, on their business income that shouldn't be there. People have an incentive to do that for taxes because it will actually lower the net income, the taxable income. They'll end up paying less taxes, which of course the IRS does not like and could get you in trouble or in problems with them.